introduction. I hope I'm audible properly.
You are.
Yeah, okay. Yes.
Nowadays, CAs are more audible and viewable.
Thank you so much.
Till 15th of September for sure.
Right. So can we have the next slide, please?
Sure. Think some issues. Just give me a second.
Yeah, this is the tax filing service by Belong that I was talking about. Anyone who is interested in getting their ITR filed this year through Belong, where you will have CAs like Sagar, do it for you. You can visit the website and start the process, avail of the service. And yeah, I think we can move on. I'll be happy to talk about it a little bit more towards the end.
Yeah. So let's start with the term NRI. I mean, NRI is the most widely used and misunderstood term as well. So I always start my session with defining what an NRI is, because like the word doctor, which can mean different in different parameters. Similarly, NRI also means different in different laws. So, for example, immigration law can mean something else. The FEMA law can mean something else, and income tax law, of course, everybody knows, is dependent on the number of days how much you spend in India. So we should not consider NRI to be a generic term, and then if I am an NRI under one law, that one law defines me, so I am an NRI in other laws as well. That kind of perception should never be there. That's why I always start with this, that you should analyze the term properly and apply them in the relevant laws. So just like the word doctor, NRI is also a very generic term. We have to analyze it in different laws. So we will start with FEMA, then we will move to income tax, and then we will take the details about NRI taxation matters. Yeah. So in fact, NRI as a term is not defined under FEMA at all. FEMA only talks about a person resident in India and a person resident outside India. And the rule is similar to how income tax is, but this is just a residual rule, and it talks about more than 182 days. So there is a subtle difference between income tax and FEMA. Income tax says that 182 days or more in a financial year, whereas FEMA talks about more than 182 days, which means 183 days or more. But still, it is only a residual clause. The other, intention why you are going out of India really matters to define whether you are a non-resident or not. By that meaning, person resident in India or person resident outside India. So, for example, even on 31st March, if you take up employment abroad and leave on 31st March, you become a person resident outside India from day one. Similarly, if you are a spouse going with your husband or wife for employment abroad, which means that your intention is to stay for indefinite period, again, you are a person resident outside India from the same day. So doesn't matter even if 364 days you have been in India, but on that particular day, that is in our same example, 31st March, you become a person resident outside India. And then there are other definitions also, like if you take up any business outside India, or for enrolling in any educational institutes abroad. So from that particular day, you become a person resident outside India. And how does it matter? It matters because all the transactions that you would be eligible to do otherwise as a resident would not apply to you. I mean, there are certain restrictions or certain limits under which you can play cross-border money movement. That applies to you the moment you become a person resident outside India. That's why this classification is very important.
Shall we move to next slide?
Yes, please.
I think the logo is getting cut. Just give me 10 seconds to present it again. Okay. Yeah. Yeah.
So, as I said, FEMA is the rule book which applies to you the moment you become a person resident outside India. So what kind of bank accounts can you maintain? Can you buy property in India? Can you buy agricultural property in India? Or how much limits apply to you for taking the money or deposits from an Indian resident? All these things will start kicking in the moment you become a person resident outside India. Now, who runs the show for FEMA? It is the RBI as well as the central government. So there are various agencies of the central government which also can influence a lot of notifications under FEMA. And the RBI issues all the notification circulars and all. The policing is done by ED, which is the Central Enforcement Directorate, and the execution is done by our last mile contact banks. So any bank which has a AD license, AD is a authorized dealer license under FEMA, that bank is authorized to operate in foreign exchange and deal with NRI kind of business. So, the banks are the last point of contact which check whether your transactions are properly going through as defined under FEMA or not. That is why, banks may ask you a lot of questions or KYC documents, or whenever you are repatriating funds, they may ask you certain forms like 15 CSCB to be submitted because they have been authorized by RBI to check the FEMA compliance. Next, please. So I like to use this analogy that, FEMA is like a traffic signal, and so it will define whether the signal is green, red. Green meaning, you're allowed to do any transaction. Red is prohibited transactions, and orange being restricted with certain limits, that kind of transaction. So FEMA will define every transaction under 3 categories, whether you're allowed to do that or not. And when you cross that signal and you reach to the other end, there is a toll plaza over there, which is the Income Tax Act. The toll plaza will never ask you how you reach there. You may have broken certain signals. You can still arrive there. For example, a NRI can still maintain a saving account, which is a non-compliance under FEMA. But because he is maintaining a saving account doesn't mean that he shouldn't file his income tax return. So once he reaches to the toll booth, he has to look at, what is the tax applicable to him and file the tax. Because non-compliance under one law should not be construed to be, doing a non-compliance in other. And the other way around is also, if you are paying income tax in India, doesn't mean that you are FEMA compliant. So still there may be certain mistakes that you have committed under FEMA. And just because you paid Indian government the tax doesn't mean that, FEMA gets regularized. For example, the same one, saving accounts being maintained by NRIs, that is a non-compliance under FEMA. Just because you are filing your returns and paying taxes does not regularize this transaction. Next slide, please.
Got it. So one question, a user just pinged me on Twitter that he won't be able to join the session, but please get the answer for this. So he's asking that what happens if someone becomes an RNOR? How is their global income taxed? I'm not sure whether we'll be covering it in next slides, but
Yes, we will cover it in the next slides.
Sure. Next slide.
So currently, we analyzed the FEMA angle, that who becomes a person resident outside India, what things apply to him, how he can maintain his bank accounts, or what kind of transactions can he do. That is all defined under FEMA. Now let's come to the Income Tax Act. Income Tax Act, as I said, is the toll plaza at the other end. It will classify every person in 3 lanes. One is a resident, which is ROR. Second is a resident, but not ordinarily resident, which is RNOR. And third is NRI. The basic purpose of this classification is to check how much slice of income can be taxed in India. So for example, a resident and ordinarily resident, just like me, who stays in India for most part of the year, has to pay tax on my global income. Whatever I earn overseas also, even if I have got shares abroad, I will have to pay tax in India. Now, the other is RNOR. In the case of RNOR, if there is any business being actively managed and operated from India, that will also be taxed. Apart from that, global income is not taxed. And the third category is NRI. Now, how do they classify it? Is purely arithmetic based. It's based on the number of days you stayed in India in the last financial year. So this is always a historic calculation. So, while filing our return of income for the last financial year, we go back and check how many days we were in India, and that determines our residential status. And based on that, everything is determined, like what will be taxed, what source of income will be taxed in India. So the first criteria is if you stay in India for 182 days or more, or stay for 60 days or more this year and more than 365 days in the last 4 years, then you become a resident. So once you are a resident, again, you have to check whether you are an ordinary resident or not ordinary resident. So if you have to qualify as a not ordinary resident, you have to be a NRI in last 9 out of 10 financial years, or be in India for less than 729 days in the last 7 years. 7 years being the year before this financial year, which we are assessing. So there is this particular exemption to citizens of India who are leaving India for jobs abroad. For them, there is a relaxation that this 60 days limit is removed, and if you stay in India for 182 days or more and stay in India for 365 days in the last 4 years, then only you qualify as a resident. And the third criteria is for returning NRIs who are citizens or PIOs of India who are coming back to India. For them, if they stay in India for 120 to 181 days in the first year when they are coming, and their Indian income is more than 15 lakh rupees, then they become a RNOR. So it's a slightly complicated calculation how your residential status is determined. It is not only based on the number of days, but here, if you see 15 lakh rupees of Indian income in the financial year also matters. So it is based on the number of days you spend in India historically, plus how much is your income in India. So that's how they classify. And once they classify, as I told you, a resident has to pay tax on global income. RNOR pays only tax on Indian income plus any business which is being operated from India. And NRI pays tax only on the Indian income, Indian sourced income. Shall we move to the next slide or any questions?
If you want, we have 3 questions related to this.
Yeah, sure.
So Ishan is asking, will OCIs also be covered?
Yeah, so there is no distinction for OCI or PIOs in this table. So it is purely based on the arithmetic calculations. So now these terms of PIO, OCI, these are all terms under the immigration laws. So FEMA will determine your intention based whether you become a person resident outside India or not. Income tax will determine purely based on the number of days stayed in India, irrespective of whether you are a OCI, PIO, or an Indian passport holder.
The another question is that can you explain the 15 lakh threshold and how it affects residential status under new amendments?
Yeah, so take an example of somebody working abroad. He gets transferred to Indian company, or he takes up an employment in India, and his income for that financial year is going to be more than 15 lakh rupees after he comes back to India. Now, if he stays in India for less than 182 days, he becomes a non-resident. But if he stays in India between 120 to 181 days, he by default becomes a RNOR if his Indian income is more than 15 lakh rupees. So let's say he comes back sometime in September or August. So he's more than 182 days in India. Then he becomes a resident, but we will have to check his history as well, how many days he has been in India for the last financial years. But if he's coming for less than 182 days and his Indian income for that year is going to be more than 15 lakhs, then by default he becomes a RNOR. That is the criteria.
Got it. So let me ask one question from Shipra, who's our assistant editor covering taxes. So Shipra, are you able to hear me?
Yeah, I can.
Cool. So one user is asking, if I travel in and out of India frequently, how do I track my days accurately for tax status? Is there any thumb rule, or in any of your articles have you covered that?
See, the very simple answer to this is that you can check the passport, the stamps in your passport to determine the 182 days criteria. But I think the distinction would be whether you're traveling for business or for leisure, and also on what visa you're traveling. So I can quote a very interesting, case that I had read quite recently here. It was an ITAT case. So there is this famous businessman called Mahadevan who runs bakeries and sweet shops in India as well as outside India. So he showed himself as a non-resident so that he doesn't have to pay tax on his global income in India. But turns out, because he was traveling on tourist visa and not business visa, and of course there were other conditions also, that all in all, he had exceeded the 182 days criteria. So he was indeed treated as a he was indeed treated as a resident, and then his global income was also taxed in India. So like, and Sagar have very clearly stated that there are two things to look at. One is the number of days, and the second is the intent for which you're traveling outside. And of course, where is your income getting generated? Where are you running your business?
Perfect. Thanks, Ibra. Helpful. Cool. So, Sagar, shall we move to the next slide?
Yes, please. We have covered this one as well. So what portion will be taxed in India? I'll quickly summarize the difference between income tax and FEMA now. So income tax is a revenue law which will look at how much they should tax you. Whereas FEMA is a regulatory law. It will determine what all things you are allowed to do or not. For example, once you surrender Indian passport for taking another passport, you may have applied for OCI, but in the meanwhile, when you surrender your passport, you become a PIO by default, and a PIO is not allowed to buy property in India. So such things are all determined under the FEMA law. So we have to look at FEMA law every time you want to do any transaction, which will be cross-border transactions. Second point was the residential status that we have already covered. It depends on more of, purpose why you are going outside India under FEMA. Whereas in Income Tax Act, it depends on a lot of factors like how many days you stayed, what is the Indian income, all these things. Again, the residential status for income tax can be only one during a financial year, because you check it historically at the end of the year, how many days you were in India, and then you classify as a ROR, RNOR or NRI. Whereas under FEMA, every time you move in and out of India, based on your intention, this can change. So your residential status as per FEMA can be different for different part of the year as well. And the purpose of classifying your residential status under income tax is just to identify what portion is taxed in India, what assets or what income should you disclose in India. Whereas under FEMA, it is generic, like, what all things can you do, permission based.
Sagar, if I may ask, I'm sorry to interrupt. If I may ask the question, Sagar, here, because this is a question that we also get a lot from our readers. You know how a lot of young professionals are setting up businesses in Dubai, and while they set up the business and they get the work permit and the work visa, they may still continue to operate out of India. So can you briefly explain what happens to those specific cases, because that turns out is becoming more and more common among young professionals?
Yeah. So if the business is set up just as a just as a structure to avoid taxation, then income tax authorities can take a view that it is kind of a structure to avoid taxes, and they may tax in the hand of the person itself, as the business is being operated from India. So even if he classifies as a RNOR, the business is being actively managed and operated from India. The business, although registered in Dubai, can have sale, purchase, turnover, whatever. But then if they can clearly classify it that everything is being done from India, or it is just a shell company kind of a structure, then it can be taxed in the hands of Indians as well. Apart from that, based on his residential status, whoever is operating that business, for him, definitely it will depend on the number of days he spent in India, whether it's, other income is taxed in India.
So I think there is a follow-up question on that same line. So one user is asking, can you explain compliances if I purchase property in Dubai?
Can we take it up later on at the end?
Sure. There is one more question from Saddam. He is asking, I worked in the USA till August 2024 and paid taxes there. Returned back to India and working here since September 2024. Do I need to offer my USA salary income in ITR?
Yes. So if you are staying in India for more than 182 days, then you become a ROR. And, based on your past history, we will have to check. But if you classify as a ROR, then your global income will be taxed in India. But if you have not traveled to India in the last years, like, out of 7 last years, less than 729 days stay in India, or out of the last 10 years, 9 years being an NRI, any of these conditions satisfies, then your global income will not be taxed in India. But if you breach both these conditions, then you become a ROR, then your global income can be taxed in India.
Vivek is asking, as my son did undergraduate in the US and now working in the US, but we don't file his return in India, as kept his income below the threshold limit. So should we file his return?
We will come to that. We have got different parameters why you should file returns and all. But if he's an undergraduate or if he's not earning anything in India, then certainly is below the threshold. So even if you're not filing, there is no non-compliance as such.
Sure. Next slide, Sagar.
Yeah. So once you determine the status, what has to be taxed in India and all, then India classifies the income in 5 broad categories: income from salary, income from house property, which is basically rent. It is not only restricted to house property; it can be commercial property as well. Then there are capital gains, which includes all the capital assets. So capital asset is also defined under Income Tax Act, and whatever is defined as a capital asset falls under the capital gains. Then income from business or profession. And the last residual clause is the income from other sources, which includes interest, dividend, and all. So we have to classify the income under these 5 categories. How it is classified, what is included in these categories, everything is defined in the law. And based on that, the tax rates also may change. For example, for capital gains, there are special rates of taxes. Long-term capital gains, for property held more than 2 years, it's 12.5% plus surcharge and cess. Then short-term capital gain can be on slab rate. Again, this example is only for property. But for other asset classes, the table is vast, it's very wide. There are different tax rates. And particularly last year, from 23rd July 2024, after the budget, a lot of changes happened. So mid-year also the tax rates have changed. So there is a table up to 22nd July if your sale happens till that date, and from 23rd July onwards, if the sale of any capital asset happens, then there is a separate tax rate. So it's slightly complicated for the last financial year. Then rental income for NRIs, it's completely taxed in India. There is, compliance to be done on every rupee being paid to you. The TDS should also be offered. We will come to the TDS slide in the next one. But rental income is taxed in India. Salary would be taxed only if you are a ROR providing, the same example of a US person coming back to India. If he classifies as a ROR, then his global salary may be taxed. Otherwise, only if the services are performed in India, only then for NRIs, salary would be taxed in India. Otherwise, it won't be taxed. Then in terms of interest and all, NRO interest is taxable in India. NRE interest or FCNR interest is completely exempt. It is good to show it under your exempt income category in the ITR. The business or profession, if it is set up and being operated from India, then only it is taxed in India in case of NRIs. Otherwise, it is not. Now, after you do all the calculation, you find out your gross total income. Then if the income is more than 1 crore rupees, then there is additional compliance, which is a Schedule AL, which is basically kind of a balance sheet, which gives you certain broad level of assets and liabilities where you have to disclose your Indian assets and Indian liabilities only. That is only for NRIs, you have to disclose only Indian assets and Indian liabilities. The Schedule FA, which applies to a ROR, which is a resident and ordinarily resident, which is a very detailed schedule, which has to show all your global assets, all global, signatories, wherever you are signatory to any of the accounts, or you are maintaining any insurance contracts or whatever, even if you're a nominee to certain contracts, everything has to be reported under Schedule FA, but that does not apply to a NRI or RNOR. It only applies to a ROR. So even if you are filing returns in India just for compliance perspective or just to maintain regularity, there is no harm because you are not disclosing your global assets. You are not paying tax on your global income. The only thing is, if you are filing returns in India, you have that regularity that you are showing to the Indian income tax authorities that how many days you stayed in India. So you are maintaining that track record with them. So, just because you are filing returns in India does not expose you to a lot of global taxes and all, because anyway you are not disclosing the Schedule FA, which applies to us, a resident and ordinary resident only.
Got it. Yeah.
Now, what are the disclosure norms in income tax return? as I said, the foreign assets don't have to be disclosed. Only the Indian assets have to be disclosed. Now, all the bank accounts have to be mandatorily shown, which include your NRE, NRO, FCNR accounts also, since they are held with Indian banks. Everything has to be disclosed. If you have any dormant accounts which you have forgotten also now, and you have not been operating it for more than 3 years, then you can leave it. But if you know the IFSC code and the bank account number, then it's a good thing to disclose all the bank accounts, because not mentioning your bank account is also considered to be a non-compliance. So it's better to disclose all your bank accounts. Then you have to select and designate one of your account. Ideally, it should be a NRO account for taking refunds if you have any refund from the income tax department. Ideally, it should be a NRO account, but if you don't have an NRO account, then you can designate a saving account. You can never give a NRE account, because in NRE account only foreign credits can come in.
Cool. So there is
Now,
one question I think could ask from Ankur, because he led the first session, and that's on the Gift City. So Ankur, if you are there, Vivek is asking, is Gift City a good jurisdiction for investment from and to India for an NRI based out of the US?
Yeah, so we have covered this at length in our last episode. But in short, I think for investing into India, it is emerging as one of the best ways for NRIs to invest their foreign income into India. And couple of reasons we discussed for that last time was there are certain fund structures that are completely exempt from TDS or tax on capital gains on the India side. So that is one of the benefits. And also you don't have to route your investments through NRE or NRO accounts. You can do it directly from your US bank account. It remains fully repatriable. So these are some of the benefits. That's one of the reasons that it is becoming a preferred way to invest. So, but currently, again, one of the limitations is that there are only AIFs available to invest in India, which has a high ticket size of 150,000 US dollars. But yeah, in the upcoming months, there are already retail mutual funds with much lower ticket size of say 1,000 to 10,000 that are already in the works and should be launched soon. So once that happens, that becomes a more efficient way to invest in India.
Got it. So 2 questions to Sagar. Shimul is asking, is renting land, raw land, comes under house property schedule or other income schedule?
No, it should come under house property itself.
Cool. Adit Raj Jain is asking, can I invest in Indian stock market from my NRE account without being taxed, or I have to transfer the money to NRO account?
NRE and NRO are two ways to invest in India. NRE is a repatriable way, wherein whatever you redeem is freely repatriable. You can take it out of India without any further compliances, because the moment you redeem anything, the TDS is already deducted. TDS is the withholding tax, which is already deducted. So you can take the money freely out of India. So it's just a tool to invest in India. But there is no difference in terms of whether if you invest in through NRE, then it will be not taxable, whereas if you invest through NRO, it will be taxable. There is nothing of that sort. Even if you invest through NRO, you can take the money out of India, but you have to do certain compliances. The limit is $1 million per year. So it's a huge limit. You can still invest through NRO account. If you have any rental or recurring income in India, you can set up an SIP through the NRO account itself. And whenever you want to redeem, you can do the one-time compliances and take the money out of India.
Cool. Shakul Sushil Gupta.
Just if I can add, I think sometimes this confusion comes from the fact that the for NRE the interest rate on the deposit or savings account is tax free. So sometimes NRIs think that okay, anything they do through the NRE account is tax free. That's not the case. The interest income is the exception. Everything else, the taxation remains the same whether it is done through NRE or NRO. The only difference is the repatriation bit.
Perfect. So there are 2 more questions and then we'll move to next slide. Sakul Sushil Gupta is asking, if NRE account accepts only foreign income, then how will the mutual fund redemption be credited into?
So NRE income or any investments done through the NRE account or foreign account. Let's say you buy an insurance policy through NRE account or through foreign exchange, the redemptions can come to NRE account. So the initial source of investment has to be proved that it was done through foreign accounts. It can be NRE or foreign currency accounts, anything.
One last to Ankur. Harshul Shah is asking, can NRI invest on gift city funds via NRO account within USD 1 million limit?
Yeah, that is possible. So once within that 1 million limit, obviously you will have to do some compliances like filing 15 CA, CB and all of that. But after that, you can take it out of India. It becomes, repatriable and you can use it to invest.
Cool. Then Sagar, your next slide.
Yes. So one or two things which I missed in the earlier slide, I'll just cover it. There is a annual information statement AIS, which shows earlier there used to be a 26As, which used to show you what is the income under which head the TDS is deducted and what is the TDS being deducted under your PAN. Nowadays, you get a AIS report. AIS is a far detailed report which shows even if you have purchased any property, even that is reflected. So all sorts of high value transactions done on your PAN, or if you redeem any mutual funds, even that is shown. Whatever TDS is deducted under whichever head, those things are shown. So, and if you have paid any advance taxes or self-assessment tax, even that is shown. So AIS is a complete summary of what you have done under your PAN, being reported to the income tax department, that you can check yourself on the income tax portal. There is a summary available which is called the TIS, which is Taxpayer Information Summary. It gives you a very nice summary of the heads of income under which everything is reported for the last financial year. So checking AIS and TIS is mandatory before you file a return, because any mismatch with that data will trigger a notice definitely. Nowadays, system generated notices are coming up. So, everybody should be aware that there is a platform, same income tax portal. You go on a tab called AIS and you can check everything, and a detailed level report is available there. If you feel certain information is incorrect or has been shown twice, like you sold a property for 10 lakhs, it is being shown as 20 lakhs. Then you can, there itself, there is a feedback button where you can go and say that I do not agree to this information. And then there are other drop downs like why you are asking this to be removed under your head. It can be duplicacy of information and all, and you can get it rectified. So that is very, very important. AIS TIS report everybody should be aware of, and they should check, on a timely manner.
One point I
Next.
would like to add on the AIS bit is that inaccuracies in AIS are particularly when you have any kind of equity transactions. It could be capital gains, or it could be unlisted equity and all that. That's because of, duplication usually happens because, there's a T+1 settlement model, but then your broker is also reporting it, and, the TRP is also reporting it, and there's a mismatch of dates because of which there's either inaccurate data or there's duplicate data. So if you have any kind of equity capital gain, you should definitely very carefully vet the AIS, because there's a high chance there might be inaccurate information for which you might have to give a feedback, as Sagar just explained.
There is one interesting question from Nilesh Sahu. What should be the best way to channel foreign savings to India for NRIs planning to return to India to avoid taxation?
I mean, I can give 2 points and then maybe, Sagar can take it. So first of all, just because you're moving your savings from one country to other country doesn't become taxable, right? Like if you can show that, okay, this is from your US account where you have already paid taxes, and then you're just moving it to your NRE account, right? So that does not make that income taxable in India. Tax has already been paid. So that's the first thing. The second thing is the RNOR status that Sagar brought up earlier. So that's like a transient status where a returning NRI can get a sort of breathing space of 1 or 2 years where their global income is not going to be taxable. So that can be efficiently used to lower your tax when you are moving assets from one country to another. These are just two like sort of broad rules of thumb. Obviously, it requires a fair bit of planning if you want to really minimize it. But yeah, I mean, Sagar, feel free to add more nuances to it.
Yeah, I mean, that's all. Your capital is not taxed because it's already taxpayer money. RNOR status is there, which is a transitionary stage available to NRIs to balance all their assets and all. And if there is any complex scenario, then we can always have a one-to-one session and discuss what all other ways can be there. But legally, as per the Indian Income Tax Act, these are the only two ways available. Apart from that, structuring them may be a possibility that we have to check. But that structure has to be made overseas.
Cool. Two more questions. One reader is asking, wanted to understand if investment is happening in MF from NRO account, then it will not be repatriable.
So NRO itself is a non-repatriable account, which means that you can still repatriate within the $1 million limit. There is no such restriction that the EMF proceeds cannot be repatriated at all. It can be anything. The entire balance in your NRO account can be repatriated, provided it has gone from the sources which you can prove. Because ultimately, when you file a Form 15 CACB, you have to prove the source also, that where the money has come into this NRO account. But if you can prove the source, if it is tax paid, then it can be taken out of India. No matter if it's a MF proceeds or rental income or dividend or interest or whatever.
Okay, got it. One more question. Krishna is asking, investment in GIFT City funds can be done only in dollars or can be through INR also from an NRO account?
Yeah, so two parts to it. Like the source can be your NRO account, as we have discussed. It has to fall under that $1 million limit per year, and you have to do the necessary paperwork to prove that the money, sources of those funds and whether the tax has been paid. But finally, when it gets invested in a GIFT City fund, those funds are usually and currently actually all of them are USD denominated. So at that point, the conversion has to take place.
Got it. Vivek is asking, do you also advise for tax filing for the US market together for the Indian market so that you are covered on both sides and without making any mistakes?
Yeah, currently we are only focusing on the Indian side. Each country has its own peculiarities. So while that is something that is in our future roadmap, as of now, we are only providing ITR filing services on the India side.
Got it. Uttam is asking, why in second applicant AIS MF showing when the purchase is done in the other first holder name? I think it's more Shipra's forte to answer. She must cover in her article. Krishna is asking, is it all right for NRI to continue hold resident saving account without converting as NRO account?
No, so that is specifically not allowed. You have to convert to NRO account within a reasonable time. What is reasonable is not defined, but the courts have taken a view that it should be within 2 months.
Got it. Cool. So Shipra, just putting it again. So Uttam has mentioned that why in second applicant AIS MF showing when the purchase is done in the other first holder name. I think you can throw some light on that.
This is one of those inaccuracies that AIS is facing. It's just inaccurate data, and you'll have to provide feedback and get it corrected. But in your ITR, report the right information. Don't report on the basis of AIS. Just get it corrected, and there should be no discrepancy at the time of processing.
Two questions I'm sure Sagar can answer. So one reader is asking why NRIs don't have online access to IES statement. That's one. Another on that same line, Krishna is asking, we hear Dubai tax authorities don't provide TRC now usually. Is it true? This is to submit to avoid TDS on MF investments done in India.
So for TRC, I think Ankur knows better about Dubai.
Yeah, I can take the TRC question. So that's not true. So actually, it's a fairly straightforward and almost automatic process. What has happened is they have revised some of the rules. So for example, now they're only providing TRC for a calendar year. Earlier, it used to be on a rolling 12-month basis, so that they have stopped. And also, they will only give the TRC on a like if you have completed 182 days in that calendar year. So only post that you can get the TRC. So these are some tweaks that they have made. But other than that, like it's a fairly, straightforward process.
So I think we have covered.
Regarding the AIS, regarding the AIS, it is accessible to everybody. NRIs can also check their AIS report. Everything is on the portal itself. If you log into your portal, there is a tab AIS, you click on it and it takes you to another page, which will show there is a drop down of different years. You can check for the last 5-6 years. I think you can check your AIS and TIS, everything is available. So there's no distinction between an NRI portal versus a resident portal as such.
Important. Sanjay Parwani is asking, I am residing in Oman, which has no DTAA with USA, whether I am liable to pay tax in India on my gains from US equity market remitted to my USD account with Omani bank after deduction of appropriate taxes in US.
So if you qualify as a NRI under Income Tax Act, then your global income, global assets are outside the Indian Income Tax Authority's purview. You won't be taxed in India for any of that.
I think one more question and then we'll move to slides, right? One user is asking, if I have not converted my savings account to NRI NRO, even after 2 years being an NRI, is it good idea to convert it now or to skip it as it's already late and might catch additional query?
No, nothing of that sort. Sooner the better. The moment you realize it, you should comply with the law. And generally, they are lenient with that. Generally, they won't penalize you as such unless there is an intention to avoid taxes or do some sort of transactions which you were otherwise not allowed to do being a non-resident. So in such cases, generally the views are very lenient and you should do it as soon as possible. You shouldn't hold back now.
Got it.
Sagar, one question, like in your, almost now 20 years of dealing with NRI taxation, have you come across any case where they have penalized someone for having a savings account?
No. Generally this happens only if there is an intention. So, where there is a black money act involved or ED is questioning some of the transactions and then they find out that the purpose why the saving account was maintained to sort of enable any of such transactions. So only in such cases that is enforced. Otherwise, I have never seen this notice. Also, for small taxpayers, this generally doesn't happen. It's a very, very common thing between NRIs to maintain saving account. And the moment you realize this, because, Indian banks are also very rigid. They'll ask you to visit a branch. Your branch may be at your hometown. You may be, living somewhere else for job. And then you have moved out of India. You don't visit that hometown again ever. So those kind of scenarios, practical difficulties are there. Now, many of the banks have also started doing this online. So you can approach your bank and check if they are ready to convert your account to NRO online itself. If that's possible, then you can do it as soon as possible.
I have a personal experience here. My husband, he's an NRI and he had a savings account for 3 years because both HDFC and ICICI Bank were insisting that he comes to the bank branch and, signs those pile of documents so that they could process it further. So yeah, it's a running risk, but I think it's a risk which just keeps running indefinitely. So yeah, that's the case.
And you have given example of the banks who are very, very, very well compliant.
Exactly.
With FEMA.
Which are like digital first and they are leading.
But imagine the other banks who are not so proactive and all. For them, it's very difficult.
Yeah, he still has a savings account in SBI because that was an account he opened when he was studying in Jamshedpur, and now he can't go to Jamshedpur just to close the bank account, so he still has it.
Yeah. So the best way is keep it dormant. Do not use such accounts. Only use the NRO. And new NRO accounts can be opened online as well.
Cool.
Sorry, can we take the earlier slide, please? Is section 195, which I want to cover.
Yeah.
So this section 195 applies to all NRIs, which says that any income being paid to you has to go through the TDS route only. So except for the exempt income, like, NRE interest or FCNR interest or life insurance policy, which is within the 1010D threshold, like, ULIP policy below 2.5 lakhs and all. Apart from that, if you are getting any income which is in the nature of income, like any payment in the nature of income, the TDS has to be deducted on such payments, which means even for your rental income, your tenant is supposed to deduct TDS. The compliances have to be done. Like TDS rate is for the slab rate income, the TDS rate is very high, which is 30% plus cess of 4%, which is 31.2%. So, 31.2% TDS has to be deducted on your rental income also, irrespective of the threshold. It can be 1,000 rupee also. But then the tenant has to do all these compliances. Then he has to take a TAN number, deposit the TDS on your behalf, and file a quarterly return as well to show that the payment has been made under this PAN. So it's a very lengthy process, but unfortunately that's the law. So any payment being made to NRI has to only go through this TDS route if it is in the nature of income. Of course, gifts from your parents or relatives are not covered here. But I wanted to cover this up that under Section 195 it's very stringent. Now this specifically matters because when you sell a property in India as an NRI, the TDS rate applies to the entire property proceeds. So the entire sale consideration, TDS has to be deducted. The rates are as per the capital gain rates, which are 12.5% plus cess plus surcharge, which can go up to 13% for if the property is sold for below 50 lakh rupees, and if it is higher than 1 crore, then it goes to 14.95%. So the entire sale consideration, on that TDS is blocked. The buyer has to deduct TDS. He has to deposit it to the government, and you can claim it back by filing a return at the end of the year. If you don't want to block your cash flow, then there is a way. You can apply to the jurisdictional assessing officer, who is your ITO. You can apply to him, fill a form 13, take the printout of all these set that this is the transaction that I'm going to undertake. And based on that, you can take a lower tax deduction certificate from him. But that is all a manual process. So, you need to plan ahead at least 2 months in advance if you need this certificate from the income tax department. Yes.
Sagar, if I'm not wrong, the form has to be obtained before the sale is done, right?
Yes. Yeah. So the form has to be obtained before the sale, and only based on that form, the lower TDS will apply. So you have to give it to the buyer that don't deduct at 14% or 13%, you deduct at this rate. To prove that, you have to give the form. Otherwise, the non-compliance is again of the buyer. So they will not listen.
Right.
Now, who should file the return? It's not only about whether you are liable to file a return in India or not. Of course, you are liable if you have a special rate income, because there is no minimum exemption limit for special rate income like capital gains and all. Even if you have capital gains of, let's say, 2 lakh rupees, which is below 2.5 lakh limit, but still you have to file a return and show that income, because obviously there will be other incomes as well, interest and all. So, you will have to file a return in India. Then if your income is only rent and interest or, slab rate income, which is the general income, then up to 2.5 lakh rupees, if you have the income, then you don't have to file return in India. But it is always advisable to file to show that your calculation of the number of days you stayed in India, that is an opportunity to show to the income tax department that you stayed in India for so many days. So it is a good practice to keep filing returns in India. Also, for your home country, they may ask you certain documents in the future, like the source of income or proof of whatever income you have been generating in India. So this becomes a very good trail for you. So having a regularity of filing returns in India is a very good practice. Then, of course, there are other benefits of getting visas or taking bank loans in India. For taking a bank loan in India, even if you are buying a property, they need your income tax returns. And for NRIs, filing backdated returns becomes a problem because they don't have any other income in India. And once you miss this deadline of 31st December, you cannot go back and file a return as well, unless you want to pay more taxes. So it all gets too complicated if you don't have a regularity in India.
Good. So there is
one point I would
user.
like to add.
Yeah,
Yeah,
Shipra, go on.
sorry, one point I would like to add, and I'm sure Sagar can. Sagar, I'm sure he sees it playing it in reality, so he'll be able to agree with me that especially if you have a property and if at any point in the future you intend to sell the property, filing ITR voluntarily, even if you don't have income or if you have minimum income, which is below your threshold, how it will help is that in the future when you apply for a lower TDS certificate, having ITR history is going to help. It will help in increasing your chances of the tax officer decreasing your TDS to the lowest amount possible, because the tax officer will be able to see that you actually don't have any income in India, so there's no reason, for a higher TDS to be deducted.
Absolutely, yes. So whenever you go for a lower tax deduction certificate, they'll ask you for the history of filing returns in India.
One reader is asking, can you please discuss the new non-dom status introduced by UK this year? Does the limit of 4 years starts from this year? My daughter has been in UK for 5 years. Her income in India is below minimum threshold, so no tax in India. Will her Indian income, including tax-free income, be taxed on UK now?
This is more of a question for a UK, CA. I'm not authorized to answer this, but yes, now they have started taxing everything in India beyond the 4-year limit.
Got it. One more question on these similar UK lines. Currently, I'm sending money from my salary account UK to India saving account. Indian account is not converted to NRO. Is it mandatory to convert into NRO even though I don't want to repatriate? How to process ITR in this case?
So as I said in the beginning, you have done a non-compliance under FEMA by not converting it, but that doesn't mean income tax non-compliance should also be done now. Income tax is a separate law. It will not care whether you have converted your saving account to NRO or not. It will only ask you whether you have filed your return or not. So, compliance with Income Tax Act should be done immediately. And also, your account should be converted to the NRO account because it's not optional. Even if you want to repatriate or not, FEMA does not give you a choice. It says what you're allowed to do and what you're not allowed to do. So there is no option given to a person resident outside India to convert or not convert.
Cool. So I think you have covered.
We have covered this. Yeah.
We have covered this also.
No. So which forms should you use? You cannot use ITR-1 form, which is only for resident Indians, and ITR-4 also cannot be used. So for NRIs, ITR-2 is the form if you don't have any business income, and if you have business income, then ITR-3 is applicable to you. Business income can also mean, intraday activities or F&O trades and all. Because of that, they get classified under the income from business. So because of that also ITR-3 may apply to you. So these are the two forms which can apply. The revised deadline is 15th September this year. It's not 31st July.
Perfect.
So what happens if you miss filing your return by 15th September? You can still file by 31st December. You will have to pay a late fee. Late fee depends on how much is your total income. If it is more than 5 lakh, then 5,000. If it is lesser than that, then 1,000 rupees. Then if there is a tax liability, then interest may also apply under different sections, like have you paid on the advance tax basis or not. So based on that, interest can also get attracted. But 31st December is the last window to file. If you don't file by then, you cannot claim any refunds. Generally, in case of NRIs, the TDS is very high and they usually claim a lot of refunds. So 31st December is the last opportunity that is available to you for any financial year. Now this special facility has been introduced. It has been extended rather now for up to 4 years. This is if you miss reporting any income and if you want to come forward and pay taxes on that, if you want to clear your tax records, then you can still after the end of assessment year, within 4 years, you can come forward and file your returns. So for example, the last financial year was 24-25. The assessment year for that is AY 25-26. And now you get an opportunity up to 4 years, which is 31st March 2030. Till that time, you can come forward and file the return for this last financial year, only in case if there is a tax liability. So if you feel you have missed reporting anything, you can come forward, pay tax. But when you go and file under this section, there is a tax on tax. So basically this additional tax liability is on your entire tax amount. This is a surcharge which is being imposed. So this is kind of a penal tax which you need to pay if you want to clear your past records. You can also reduce your tax liabilities with DTAA. India has double taxation avoidance agreements with all major countries, around 85 to 90. Now you can claim double taxation benefit. This is basically a treaty between two countries which says that what portion of income will be taxed in one country and what won't be taxed, or how we are going to give credit between two countries. So if a citizen of UK comes to India, then how will his income be taxed in UK versus India? Everything is given in this treaty. So there are different, treaties, different wordings in every treaty. There are certain benefits also available. For example, India UAE treaty says that for capital gains it has given 5 different asset classes, and there is a residual clause which says that anything not mentioned here will be taxed in the home country wherever the tax resident is staying. Now, considering that terminology, you can take the benefit that since there are no taxes in UAE and mutual fund are under a residual clause, you can potentially pay 0 taxes on mutual fund income in India, irrespective of whether the investment is made through NRE, NRO, or while you were a resident and now moved out of India and all. So, that kind of benefits are also available under a DTAA. And then there are reduced taxes, or how the taxation would work for overlap in any particular year. That all is mentioned in this DTA agreement.
Interesting. So here, just want to point out one thing. So a lot of NRIs, that we have seen, assume that DTA means that it will be taxed only in one country, which is not the case. Right? DTA just means that the same income will not be fully taxed in both countries. Right? So at the base level, generally, while it is taxable in both countries, you can avail of the tax credit that you have paid in one country in the other country. Generally, you will end up paying tax at the higher of the two. Some in one country, some in another country. But don't just assume that because you have paid tax in India, it doesn't. It means that it's not taxable in US or vice versa.
Yeah, and even for claiming the DTA benefits, there is a procedure given. It's not automatic. So there is a procedure that needs to be followed. So if we continue the example of UAE, you need to take a TRC, which is the tax residency certificate from UAE, that you were a resident of that country. Now, if suppose you have done some sale in 2024, then you need it for the calendar year 2024 to show that you were a tax resident of UAE during that calendar year. Because they follow the calendar year, we follow financial year. Everything that we talk about is from 1st April to 31st March. So, if they are giving you for the calendar year, then you need to take the TRC for the year which is under question. Then we have to upload that TRC along with a form 10F. So 10F is basically all the details are mentioned in the TRC itself. It is designed in a way that, English translation can be given for that particular document. Then once you upload that, then only you can take the DTA benefits, and this has to be uploaded. The form 10F has to upload it before you file your return of income. So until and unless you file these forms, you won't be able to claim the DTA benefits. And if you don't and then still file under the DTA, then automatically another notice will get triggered. So there is a procedure which needs to be followed to claim all these DTA benefits. It's not automatic. So here are some of the key pitfalls. Wrong residential status. This is a very common mistake which I've seen amongst a lot of NRIs. They say that, since I'm maintaining savings account, let me file as a resident Indian. Show the income under a presumptive basis, which is only allowed for residents, and pay only tax under the presumptive mechanism and all. But the moment you declare yourself to be a person resident in India, I mean a ROR under the Income Tax Act, then Schedule FA gets triggered, which is the schedule of foreign assets, and your global income becomes taxable in India. So, don't commit this mistake of miscalculating or showing something just to be, make it convenient. Then I've included this, that AISTS has to be checked properly. Any sort of exempt income, since it gets hit to your bank account, you should report it under the exempt income category. Last year, we saw a lot of notices coming for the NRE interest and FCNR interest also. So it is a good practice to keep reflecting exempt income also in your returns. Then agricultural land or farmhouses or any agricultural related property or business is not allowed to be held by a non-resident NRI. So that can be an Indian passport holder, OCI holder, or a PIO. Nobody is allowed to invest in agricultural property in India. You have to be very careful about this. The only way you can acquire them is through inheritance. Apart from that, there are certain limits if you are taking any gifts from your relatives, or if you're lending to any of your friends in India. There are certain restrictions, there are some regulations which you need to follow. There is a LRS, which is the liberalized remittance scheme. So any resident in India, let's say your parents can send money to you, but only up to $2.5 lakh per PAN per year. It cannot be split in different accounts or anything. It has to be in different PAN. So the limit applies per PAN. So let's say, one person cannot gift to two children $2.5 lakh. The limit is per PAN. So all these limits have to be properly checked and followed, because later on these notices are very draconian. And we have covered this also, that if you want to plan TDS, lower TDS certificate and all, you need ample time in hand to get the Section 197 certificate. I think, yeah, we have covered all these points.
Yeah, I think we can just quickly talk about about belongs India's ITR filing for NRIs. So as we have seen, like it can get quite complicated very quickly. So anyone who is looking for an expert like Sagar, to file their taxes this year, and now given that things are getting automated from the income tax department, a lot of notices are being triggered. It's always better to stay on the right side of compliance. So we'll be happy to assist them. We have experts like Sagar who will do the entire end-to-end filing for you. I think there's a QR code on the next slide which you can scan to go to the website. It's getbelong.com, and there you can request our services, and tax expert who is well versed with NRI tax laws will handle the entire process for you. So I think that was the presentation. We can take some of the questions now. I think a lot of questions have been coming.
Yeah.
This slide is particularly with to do with India UAE DTA. So if anyone has any questions, we can use it. Otherwise, we can just stick to the questions that have been posted.
Yep. So let me pick up. Yeah. So Krishna is asking, are there any circumstances or conditions under which repatriation from an RO can exceed USD 1 million in a year?
Yeah, so mistakes do happen even from the bank's end. If you are using multiple different banks, and simultaneously, if they also report it to RBI on a periodic basis. But if the same transaction gets triggered from different banks in the same period, mistakes can happen from the bank's end as well. But the compliance responsibility is on the person doing the transaction, because ultimately he's signing the documents for sending the money out of India. So, it is the responsibility of the person who's remitting money.
Cool. Vivek has a question. As my son is an NRI, had taken insurance policies in his name and some being money back policies, and which would have given some regular payments, will these receipts be needed to be reported and taxed in US return filed? So on advice, got the insurance policy is absolutely assigned to the mother.
Assigning of policy will not change the taxation of that particular policy. Assigning will still, still the income will be taxed in the name of the proposer, and whatever tax laws applies to that particular policy will apply to him as well.
Ramesh Chandra is asking what's the way to save tax on NRO interest?
So there is no tax on NRO interest. There is only a TDS. The tax is still the slab rate only. If your total income during that year is within the slab rates, then you get away without paying any taxes. There is only a mechanism to collect the advance tax, which is called the TDS, withholding taxes. That can be claimed by filing a return of income. There is no tax as such on the NRO income. Tax is only on the slab rate income.
One reader is asking what
Just one point here. Sorry, Amrendra. So Sagar, like, is it advisable to move this money from NRO to NRE and then get rid of the TDS also? Obviously, some paperwork will need to be done. Like, this
Yes.
is common practice?
Yeah, it's a common practice. So if you have accumulated money in the NRO account, it is best to transfer it to NRE, put to use through NRE so that it becomes repatriable. But of course, it depends on the quantum as well. Because if recurring income is coming like a rental income, then it makes sense to have a SIP in the NRO account itself.
So one reader is asking what if the tenant has not deducted TDS on rental payments to NRI landlord due to some reasons? Can that be paid later or start from the point this is known? Are there penalties or interest payment due for tenant to pay?
So to be honest, 99% of NRI tenants do not deduct the TDS and all, unfortunately. And the responsibility of this payment deduction and all is of the person making the payment and not the NRI landlord. You can just tell him that these are the provisions which apply to you. The notice can come to you because obviously he may be claiming HRA benefits and all as well. So it's better to comply. But if the tenant doesn't want to comply, then there is nothing much an NRI can do.
I think this is a question to Cipra, not question but a request. Would also request if you could give suggestion to the finance ministry to simplify and reduce taxation for locals and NRIs investing home, so there is an ease of capital flow on both the sides, and if you could offset Dubai to some extent, taking into consideration of the current tariff scenario. I think Shipra will speak to Mrs. Nirmala.
Yeah, that's a long-standing demand from everybody. But no, you're right, and this is precisely what we strive to do it through our stories also, to highlight challenges that affect NRIs, residents when it comes to taxes, so that because we know that our newspaper gets read by the ministry and in the revenue department, so that these challenges are highlighted to the government, they can see what's happening and they can work towards it. And yeah, we will continue to do, continue to keep doing the work, and of course, keep sending us your, what you're facing. What is it that you think should be changed? What are the challenges which are really, really affecting NRIs? And yeah, we'll be, happy to take up those matters, write on them, flag those matters, and hopefully it will fall on the right ears, and something will be done about it.
Sure. Thanks, Shipra. So Krishna is asking. Yeah.
I actually have a question. So I've got a message from one of the attendees, and the question is for Sagar. That Sagar, can you please tell me what is the government fee for UAE TRC?
Yeah, I think I can take that. So for UAE TRC, so the government fees is around 1,200 dirhams, which will roughly be equivalent to 23,000, 24,000. So you can assume that you will end up paying like around 25,000 to get that TRC, and it is something that you will need for every year that you are claiming to be an NRI. So it's not
Right.
like it's not cheap, right? So you have to really weigh the costs and benefit. Like if you're if the amount of capital gains tax that you are going to save are roughly in the same range or lower, then it does not make sense to do that.
Okay, thank you.
Krishna is asking, are there any circumstances or conditions under which repatriation from NRO can exceed USD 1 million in a year?
Yeah, I think
This
we
we have
already
already covered.
yeah.
Yeah, actually my question was, by any chance, is there any legal way of repatriating more than $1 million in a year from an NRO account? That's the question.
So you can split it up between two PANs if it's going to be through the spouse and all. There are ways, if there are more than one people is going to send the money, that can be done. These limits are per PAN. So it can be seen whether that can be worked out. Apart from that, you need to apply to RBI to get a permission, which usually takes so long that the next financial year arrives by then, and then you can transfer.
Got it. Raja is asking a question. Recently, I heard that NRIs don't have to pay tax on mutual funds. Is that correct?
That is the side effect of a lot of influencers.
That sounds more like wishful thinking than question.
Well, Vivek is
I
asking.
think this question might be coming from that peculiar case that came out of Singapore, where that woman had fought a case and she was able to say, the ruling was in.
Okay. So one question is that, is the policy still there to remit funds to an international subsidiary and up to 4 times the net worth and then do worldwide business and let the profits in the international subsidiary till you declare dividends and then it gets taxed in India? So any tax efficient structure for international business?
Yeah, so this can be analyzed on a case-to-case basis. It's kind of a complex question. Yes, can be worked out.
Cool. So Pooja Kabra is asking, if an NRI files ITR with normal residential status, what can be the consequences?
If you're filing as a ROR, then you are declaring yourself to be a resident of India and you're offering your global income. They already know your global assets because under CRS framework, all your global assets get reported to the income tax department. In fact, we see a lot of notices coming to NRIs who have filed this way. And then, since you have filed as a ROR, your return becomes defective because you have not filed Schedule FA, which is the Schedule of Foreign Assets. You have not paid on a tax on the global income and all. So you have to revise the return, and a lot of hassles do happen later on after you get a notice.
So Sagar, here, let's say if someone, by mistake or for whatever reason, was an NRI, ended up filing it as a resident Indian, like how can they fix it? And during what time frame can it be fixed?
This window of the ITR-U is still available up to the end of 4 years from the end of financial year, assessment year. But then it depends, if there is a tax to be reported only, then you can file a revised return. Otherwise, we will have to see which notice is it. Are they allowing you to revise your calculations and all? So it all depends on a case-to-case basis. There is not a single thumb rule for such cases.
What about till the 31st of that year? Then can it be done?
Yes. So you can revise the return. Yeah,
can be done.
You can revise the return. Yes. Till 31st December, you can still revise your returns.
Got it.
So we'll take 2 last questions. One reader is asking, actually question was about non-payment or TDS for rental due to mistake was from tenant perspective, not NRI landlord. Please, can you address what if the tenant has not deducted TDS on rental payment to NRI landlord due to some reasons? What are the consequences and can it be paid later?
So there are penalties under TDS non-compliance and all. If they get a notice for TDS non-compliance, then you have to, give your reasons, then pay with interest, whatever the penalties are there. So it's another lengthy process.
One user is asking, if going to US for a fixed term employment with intention to return back to India, is it necessary to convert saving accounts and existing FDs in NRO accounts?
No, the FEMA law specifically says that it has to be for indefinite period. So even if you are going for employment, just like a 30-day kind of a contract and all, you don't automatically become a non-resident. But if it is going to be for a longer tenure, which includes in any particular financial year stay more than 183 days outside India, then definitely, yes, you become non-resident in that particular financial year. So for example, 2 years contract can make you non-resident for the second year.
One follow-up question here. A lot of MNC employees go on secondments of 1 year, 13 months, 14 months. So in that case, should they move the savings account to an NRI NRO account or not? And what kind of compliance applies to such MNC employees?
See, generally, in any particular financial year, if the stay is more than, if it's not in India for 183 days or more, then you become a non-resident. It is a residual clause. So even that has to be explored. But then if it's going to be a stay for like 2 years, 3 years, then this question can arise. But if it's a question of 1 year or 14 months and all, obviously there will be an overlap of 2 different years as well. So we have to
Yeah.
analyze as per that year what applies. Generally, it's not possible to convert to NRE NRO just because for that one particular month's threshold you're crossing, and then again convert to saving account and all. It's too much of a hassle,
Yeah.
practically speaking. Yeah.
Got it. Perfect. I think we have covered all the questions. I'll give a minute more to the audiences if they want to ask question. But thanks, Ankur, thanks, Shipra, thanks, Sagar, for offering such a fantastic session. I think taxation is something which is for everyone's interest. Uh, it would be more interesting if you could also cover one slide on how to save taxes. Then I think the audiences would have been quadrupled what they have joined. But fantastic, it's good to understand. And the kind
Yeah.
of
On a lighter note, sorry, we do have a consultation call through Belong as well, how to save taxes. So you can go through that route.
no, that's perfectly fine. I would encourage these people to reach out to Belong and get their queries sorted out, even avail their services, right? But fantastic, good intellectual questions coming in from all these NRIs. A lot of answers have helped these guys to become more compliant and more clear, more crisp. So perfect. Thank you, everyone. We'll be covering banking for NRIs in India as our 4th session. We'll reach out to you with the date, timing, and everything. It's scheduled on 12th of this month. That's also going to be a much more interesting. We'll be anchoring a lot what Sipra and Sagar were debating that what if I am working in an MNC, been out of the country for 13 months, 14 months, or on a project or on an assignment, what kind of account should we use? What are the compliances? I think that's going to be super interesting as everybody is exploring some or the other route to go outside India and work for some period. So thanks everyone. Thanks Sagar. Thanks Ankur. And to all the viewers, we'll be sending out the deck and the recording of this session. Also the QR code of the Belong, so that in case you want to avail their services, please do reach out to them and ask for a discount since you are a Mint subscribers. I'm sure Ankur will be more generous to Mint readers. Cool. Thank you.
Sure.
Thank you everyone. Have a fantastic night.
Thank
Thanks.
you.
Thanks, Amrendra. Thanks,
Thank
Shipra.
you.
Thanks.
Thank you.
Thank you for all the listeners for joining in. Even I got a lot of takeaways from this session, and I'm sure I have got a lot of story ideas also from the session. So yes, it was a delight joining this session. Really good one. All right.
Thanks,
Thank you,
Shipra.
everyone.